You are in a good rental situation, which feels like financial safety. You think you are winning by avoiding maintenance costs and preserving flexibility. But this feeling of security often masks a silent wealth transfer happening every single month. The math suggests that staying in your current home is not just about renting. It is an active decision to leave massive generational wealth on the table due to equity capture and leverage. When you compare rent versus buy, most people look at their monthly budget line items. They see a lower payment for renting and feel relief. This creates the good rent fallacy. It ignores that renting is purely a consumption expense with zero equity capture. When you pay your landlord, that money vanishes into their pocket as income or profit. You are paying someone else's mortgage while they build an asset in their name. In contrast, homeownership utilizes leverage to force equity accumulation on the entire property value, not just the down payment you put down initially. This dynamic is where the 30-year wealth gap begins to widen significantly. A homeowner using a mortgage leverages a small amount of cash control over a much larger asset. If that home appreciates in value, the return on investment applies to the full price tag, not just your initial contribution. The renter pays for housing services but captures none of this appreciation. They are essentially funding another person's wealth accumulation while their own net worth remains static regarding real estate assets. We see evidence of how rental markets function as vehicles for massive wealth redistribution when we look at regulatory interventions. Research from Ahern and Giacoletti in 2022 highlights that policy changes can trigger billions in wealth transfers, though the direction depends on who holds the keys to these properties. This study substantiates a core thesis. Rental markets involve significant, often invisible mechanisms of wealth redistribution that simple monthly cash flow comparisons fail to capture entirely. The cost of renting extends far beyond what appears on your bank statement into potential equity loss and missed appreciation opportunities over decades. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The financial reality is stark when we consider the long-term horizon. Housing acts as a critical hedge against rent risk for owners, whereas staying in a rental exposes the tenant to infinite inflationary exposure on housing costs. While rents rise with the economy or even faster during supply shocks, your landlord captures all that appreciation and passes it along through higher payments next year. You are left paying more every single year without gaining any ownership stake. This effectively transfers generational wealth from the renter to the property owner over time. There is a dangerous signal hidden in what feels like a good deal. Studies on rent control, such as those conducted in St. Paul, demonstrate that suppressing rental prices creates negative externalities that depress property values by 6 to 7%. This proves that good deals in controlled markets often signal underlying wealth destruction for the community and potential future instability. A lower monthly payment might be a sign of market distortion rather than an opportunity. It can indicate deferred maintenance or systemic issues that will eventually impact your ability to renew leases or maintain quality living standards without price hikes that outpace inflation once controls are lifted. The leverage effect becomes even more potent when you consider the compounding nature of home equity. A homeowner who buys at age 30 and holds for 40 years sees their initial down payment multiplied by market appreciation on a leveraged basis. The renter, meanwhile, must save enough to buy that same asset later, often finding themselves priced out because they did not participate in the earlier growth phases. By waiting for perfect conditions or fearing maintenance costs, you are betting against your own long-term financial security. You are assuming that rental rates will remain stable relative to income and home prices forever, which history suggests is a risky assumption for any household budget. The emotional safety of flexibility comes at a steep price tag over 3 decades. The fear of making the wrong move keeps many in good rentals while they watch their peers build net worth through property ownership. But this hesitation often stems from focusing on short-term cash flow rather than long-term asset accumulation. When you factor in inflation, tax benefits like mortgage interest deductions for those who qualify, and the forced savings mechanism of a principal payment, the economics shift dramatically. You are not just paying rent. You are buying your own future income stream through reduced housing costs in retirement, compared to continuing to pay market rates indefinitely. The decision is ultimately about whether you want to be an investor or a consumer for 30 years. If you choose renting, you accept that every dollar spent on shelter generates no return for you personally. You are consuming the service of living there without building equity. This choice defines your wealth trajectory more than most other financial decisions because housing is typically the largest asset and expense in any household budget over a lifetime. Understanding this distinction changes how you view every lease renewal, every rent increase, and every market fluctuation. The path forward requires looking past the immediate comfort of a flexible agreement to the mathematical certainty of wealth accumulation through ownership. While renting offers freedom from repairs and maintenance headaches, it does not offer freedom from paying for housing forever without owning anything in return. The evidence suggests that staying in your current home is an active decision to leave massive generational wealth on the table due to equity capture and leverage. It forces you to confront whether short-term comfort is worth sacrificing long-term financial independence. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.